thank you so much, Christina, for having me. Once again, my name is Tony Watson. The company I work for, Robert Hall & Associates. We have one location based right here in Glendale, California, but we service tax filings in all 50 states. Anyway, so I did switch screens here. We are going to talk about the CARES Act and all of the good stuff that came from that. I just wanted to show you that it's not just me here at Robert Hall sitting in a closet with a green screen. I'm actually sitting in my office here in Glendale at the moment. Thank goodness I'm able to come to an office and work. I tried to do this during tax season at home, and I realized I just wasn't as efficient at home as I am here at my office. So we're a skeleton crew right now because of the pandemic. We've only got about 11 people here at the office. Normally, we are full staffed with about 50 people backing the Robert Hall name. We've been around for quite some time, been around since 1971. I myself am going on my 15th or 16th year with Robert Hall & Associates. I myself service about 1,200 tax filings per year all across the U.S. A majority of my clients are real estate investors, real estate professionals, and small business owners. So, and I also have the wonderful position here at Robert Hall to not only do what I teach, but also to be able to teach people about what I do. So it's been a wild ride over 15 years. And I'm really happy that I'm able to join groups like FIBI. So thanks again for joining today. Let's jump right into the main topic, the COVID-19 changes. What came out of this CARES Act that was passed? Was it passed efficiently? Was it fine-tuned before it was released to the general public? Has the dust finally settled around the CARES Act? Well, there were a million questions. As soon as the CARES Act actually rolled out and was implemented, our phones were ringing off the hook. Even though we were working off-site, we had this phone system that was redirecting calls, and we just felt like even with 50 people working for our firm, we just couldn't service all of the phone calls. We did, but it just felt like there were so many questions from morning till night about what the heck was going on. What did the PPP and the EIDL loans mean for you as business owners or real estate investors, and questions about mortgage forbearance and accelerated depreciation and what was going to happen with exchanges and recapturing depreciation. So tonight we're going to talk a little bit about everything. Obviously, these topics alone could lead us down a road of 10 hours of education. I'm not going to do that to you tonight. So I'm going to try to cram it into this 30, 45 minute time frame and really leave you with a lot of good information. So please screenshot the screens here. If you want copies of the PowerPoint after the presentation, I can always send you copies of the PowerPoints. But tonight is going to be a lot of information coming directly from me. So this list right here that you're looking at, these were the top 5 things that we were fielding calls for starting all the way back in early February. We are still fielding a lot of the calls about the PPP, the EIDL loans. Mortgage forbearance has kind of tapered off. It's not really a topic of conversation, but we're going to talk about it tonight. Accelerated depreciation, that's been one of the main questions from all of my real estate investors. What does it mean? What should I do with 19's return? Can I go back and amend 18's return, or should I just look forward for 2020 and changing it then? And then also the stimulus checks. We'll talk a little bit about that. They are still being cut, by the way. So if you have not received your stimulus check yet, do not worry. If you met the threshold, the income threshold to qualify for it, you might not get your check. If you haven't gotten it yet, you might not get it until the end of the year. Let's say the year end passes. Don't worry, because next year you can actually apply for this $1,200 payment on your 2020 tax return. So we'll talk a little bit more about that. And most importantly, the #1 crime in America that impacts us all, identity theft. What to look out for during this COVID-19 economic shutdown and coming out of it, what we should be aware of when we're online shopping, opening up emails and clicking strange links, joining new networking groups. You just got to be really careful. I mean, FIBI's been around for quite some time, and Christina's been doing this, and she's a trusted source. But any new groups that you're starting up with where people are promising, well, we'll get to that slide, and I'll talk to you about some of the scams that are currently going on. Jumping right into it, the Payroll Protection Program, one of the more popular loans that people were applying for. The Payroll Protection Program was really meant to do one thing for business owners. It was meant to keep them earning a payroll or keeping their employees on payroll. Most of the rest, we've heard about the restaurants going through this whole issue where they're shutting down. Restaurants that have been open 20, 30, 40 years. All of a sudden they have to shut their doors because they can't afford to keep their staff on payroll. Nobody's coming into the restaurant, obviously not spending money. And some restaurants couldn't quickly switch over to the Postmates and the Grubhub platform, obviously, especially if they were an older restaurant. They just couldn't transfer that quickly enough. And so the Payroll Protection Program, part of the CARES Act, was meant to support that restaurant over a 2.5-month period and keep their employees on payroll. Now, a lot of people, when they hear payroll protection program, they think, oh, well, I have to have a payroll in order to benefit from this. And that's not the case at all. Yes, payroll protection program was meant to keep these companies' payroll employees on payroll and keep them employed. But the payroll protection program actually has a portion of it that helps sole proprietors as well. Sole proprietors meaning that you are a self-employed, either real estate professional or self-employed business owner, earning self-employed either commission income or just self-employed revenue from a business that you own. The payroll protection program was meant to support both of those business owners, whether you had employees or not. So applying for the loans was kind of a real mess at the beginning. Right now, it's actually become a little bit easier, a little bit more efficient with a financial institution, going onto the SBA website and filling out the form yourself. But you had to pick and pull information off of either a tax return that was filed for 2019, either filed one or a preliminary return, or you could put together 12 months of bank statements and basically tell the bank that you were applying for the loan, this is how much I was making each month in revenue and profit through my business. So the application process was a little strange. A lot of people thought that they could just go online and fill it out. And for the most part, that's what most people did. But their applications were getting held up because they weren't using the correct information when they were applying. PPP is still around, by the way. A lot of people thought that the PPP program shut down at the same time that the EIDL program shut down, which we'll get to in the next slide. But PPP is still very much available for the self-employed business owner. And the reason why it's so unique is because when the CARES Act first passed, they were pitching the payroll protection program as a forgivable loan. Meaning that at the end of the day, if you used the payroll protection program and spent the money on what were allowable expenses, then the SBA essentially would forgive the debt. They wouldn't require you to pay it back to them. Well, let's talk about how much you might have qualified for and then how much of that loan you actually have to spend on specific expenses real quick. We'll break it down into a really easy kind of 5-6 minute conversation. When you applied for the loan, the main numbers of how to calculate what you were supposed to receive from payroll protection program was you took 12 months of your company's profit, essentially, if you're a sole proprietor or a business. And you take the 12 months of profit, you divide it into 12 months. Let's say that you made $120,000 last year and you made $10,000 each month, just for ease of calculation. Well, you take $10,000 per month and you multiply it, simple calculation, you multiply it by 2.5. 2.5 actually is a very specific number, right? 2.5 was the time frame that the federal government assumed the economy would be shut down for, 2.5 months. And so therefore, the payroll protection program was a calculated amount over a 2.5-month period. Well, 2.5 times that $10,000 amount gives this $120,000 profit business a $25,000 PPP loan. Now, this money, as soon as you had an accepted application for the PPP, you got the $25,000 into your business bank account. And as of last Friday, so Friday and before, dating back to when the CARES Act was passed, you had 8 weeks from the date the loan was funded to actually spend that money on qualified expenses. Okay, and we'll get to the qualified expenses in a second. As of last Friday, though, SBA came out and said, hey, listen, don't worry about the 8-week time frame being the qualified time frame right after the loan funds. It can actually be an 8-week period as soon as you start up payroll again. So let's say it takes you a couple weeks to get your business back up and running. As soon as you start issuing that first round of payroll again, that can be the start date of the 8-week time frame. I mean, talk about what a mess this has caused, because up until last Friday, people, as soon as they got the money, they started spending it on all of the qualified expenses. Whether they had it or not, they were just spending the money, because that's what the CARES Act told them to do. And so as of last Friday, they changed it. And that's why I want to point you to the bottom left of my screen. Every slide in today's PowerPoint is going to say that this information is subject to change, because even though we have the CARES Act and they're talking about issuing this HEROES Act with another $3 trillion or whatever in government funding, and EIDL and PPP will get more money as well, understand that there are some things that will be fine-tuned over the next, 5, 6, 8, 10 months, probably all the way through the end of the year, if not into next tax season. So understand that when you got that money, at one point, the rule was that you had to spend it all within 8 weeks after you got the money. But now it's actually 8 weeks after the start date of when you start issuing payroll again for your business, or as a sole proprietor, when you start taking some of that money in as payroll for yourself to supplement this downtime for your business. So the way that a sole proprietor would calculate this is very much the same as payroll, right? You take your profit, you divide it by 12 months, and then you multiply it by 2.5. Once that money came into your account, though, this $25,000 amount, just for ease of calculation, that 8-week period, let's say it starts now. Well, you had 8 weeks to take 75% of that loan and pay it as payroll to either your employees or to yourself if you were a sole proprietor or you are a sole proprietor. So let's say that you are that sole proprietor who made $10,000 a month. Basically, what you need to pay yourself or continue to pay yourself once you got the PPP loan is $10,000 a month. Well, that divides into $2,500 per week. So over the next 8-week period, you have to pay yourself this $2,500 amount out of the PPP loan. So what we've seen a lot of clients do is set up a separate checking account to receive the PPP loan money to kind of keep it separate, more organized that way. And then every week they were drawing $2,500 in this particular situation, $2,500 to their personal account to supplement this payroll protection program, supplemental payroll. The reason why this 75% amount of the loan is important is because in order for you not to have to pay the loan back, you had to hit these specific expense numbers in order for the loan to be forgivable. Now, 75% is the minimum of the loan that you had to spend on payroll. If you spend 100% of it, great. None of it has to be paid back. It's all 100% forgivable. And so therefore SBA will say, hey, we have forgiven the debt. Once you apply for the forgivable debt, there's a whole application that you have to fill and submit proof that you use the money for forgivable expenses. But once you get that acceptance, you no longer have to pay that back. And at the tail end of the year, you do not have to include that as income on your tax return because it was a loan. It wasn't income for your business. Now, here is where a lot of people got confused or are getting confused. When you say forgivable, you mean that you don't have to pay it back. I get that. When you say forgivable, that means that that was not my money. I don't have to pay it back. So if I use that money to pay for business expenses under the current Internal Revenue Code, and once again, this information could change, but under the current Internal Revenue Code, whatever you use that money for to pay, like expenses for, you cannot deduct those expenses on next year's tax return. So meaning that if you paid yourself payroll or if you paid your employees payroll with the PPP loan, that wasn't your money to begin with and you don't have to pay it back, the Internal Revenue Service is not at the moment going to allow you to deduct that payroll as an expense. How crazy is that, right? I think that this will change definitely over the next couple months because the federal government will learn that, hey, as we get closer to the end of the tax year, we need people to have these write-offs because we can't just all of a sudden not allow this deduction. And once the economy gets back up and running, now all of a sudden their tax bill shoots through the roof. It would just be silly. So I think that there will be a continued relief kind of plan in place for this particular change. Now, once again, 75% has to go to payroll. 25%, if you can only use 75% of it to pay yourself, you can use the remaining 25% to pay for business rent. You could use it to pay for medical expenses, health insurance. If you have employees and you cover their health insurance, you could use it to pay for that. You can use it to pay for business mortgage payments. So if you own the building that you work out of, you could use it to pay for the mortgage payments. You can use it to pay for business loan debt. So if you have other business loans, you can utilize that money for that. Let's say, for instance, that you can't spend all the money. I know that's it's kind of a weird situation to talk about, but I have a client who has actually picked back up their business off-site, obviously, not in the same location, but everybody's been set up individually. And so their business has picked back up. He could keep everybody on payroll. And so at this point, he doesn't really need the PPP loan. So his question to me and to our firm was, well, what do I do with that money? Because I understand that because I don't have to use it for these expenses, well, the government's just not going to let me keep it without taxing me on it or something, right? Well, the PPP loan, if it's not used to pay for payroll expenses, if it's not used to pay for forgivable expenses, it converts to a loan with a 1% interest rate over 24 months. And the reason why I think these businesses should keep the PPP loans, especially the small businesses, is because we have so much uncertainty in the future. We don't know when business and when the economy will start to pick back up. We hope that we are going to be opening across the United States over the next couple months. But who knows the trickle down impact in industries of all industries, how that's going to impact their business and their ability to get back on their feet, right? So this PPP loan really gives them an option. You know, they can pay for the payroll expenses over a 2.5 or a two month period, 8-week period, or they can hold on to it and use it as a 1% interest rate loan. So there are some options that you have. And a lot of clients say, well, I want it to be fully forgivable. Well, just pump the brakes for a second, because you don't know what next year has in store for you. Don't go and spend all of the money on things that you could probably afford on your own. Let's make sure that you have this little nest egg carrying forward into the rest of this year and the future year, just to have a little bit of a security blanket at 1%, right? So the payroll protection plan was very, very unique. The one main goal of the PPP plan was to keep employees on payroll, to keep you from losing money, from losing assets, from going into a negative account with your broker, or whatever your expenses were as a business owner. So employee retention was the number one thing the government saw for the payroll protection program. Some of you might have heard this employee retention term before, and there are two things under the CARES Act that deal with employee retention. The payroll protection program was meant to retain employment, right? That's one part of the CARES Act. But then also introduced under the CARES Act was something called the employee retention credit, which has nothing to do with the retention benefit of the payroll protection program. The employee retention credit actually is only for business owners who pay themselves on payroll. I'll give you an example. Let's say that you're a property manager, you have yourself set up as an S corporation, and you are on payroll, your spouse is on payroll. Let's say you have your children on payroll, and all of a sudden, the pandemic sets in, you apply for the payroll protection program. This payroll protection program kicks in. You can pay all of the payroll as it's been over the past 12 months to supplement for loss of revenue. But then on top of the payroll protection program, because you have payrolled employees, before the end of this year, you can apply for a $5,000 employee retention payroll credit per employee. Okay. So this is something that you need to have a discussion with your accountant about, saying, okay, well, I heard that there was a credit involved, and because I have payrolled employees at the tail end of the year, you're saying that I could apply for each of those individuals up to a $5,000 credit to offset their payroll. And that's exactly what it is, the employee retention credit. And this is something that will not have to be paid back. It's not income to you. It literally is part of the CARES Act that pays for up to $5,000 in payroll costs if you have employees on payroll throughout the year of 2020. So this is definitely a conversation you want to have with your tax advisor if you are set up as an incorporated entity and you do have payrolled employees, whether it be yourself, your children, your neighbors, your cousins, your nieces, nephews, whoever you employ. This is something that you could potentially qualify for. Not everybody's going to get the $5,000. Because the $5,000 is the max credit, but you could apply for whatever the allowable amount is that you would qualify for. So keep that in mind. Keep that in your notes to have a conversation with your tax preparer about. That is going to be a huge benefit for this year. Now, the payroll protection program, once again, if you don't spend it, it turns into a loan at 1% interest rate. The EIDL loan is something completely different. The EIDL loan is separate from the payroll protection program. Can you apply for both, or could you apply for both at one point? Yes. But the payroll protection program was meant to keep you employed. So applying for the PPP and applying for unemployment at the same time was a big no-no. You don't want to apply for unemployment when you have a payroll protection loan that's meant to keep you on payroll, right? Because that means that you're not unemployed. If you didn't apply for the PPP and you applied for unemployment, whether it be the W-2 wage unemployment or whether it be the self-employed, the PUA here in the state of California, you don't want to apply for the PPP at that point because they contradict each other, okay? The EIDL has nothing to do with the payroll protection program. This is a completely separate benefit that was built into the CARES Act that unfortunately has closed for the time being, meaning that SBA is no longer accepting current filed applications that you're filing now. They are only in the midst of processing applications that have already been filed. Okay, so now because of the HEROES Act, this might open up very quickly. In fact, I think it's supposed to open up under the HEROES Act, depending on how much money goes into the EIDL and the PPP programs. But the EIDL, one portion of the EIDL is an actual loan. It's not a forgivable loan like the payroll protection program is. And then another portion of the EIDL is something called an advance or a grant amount of the EIDL. So when you went to apply for this loan, there was actually a checkbox that you would check whether or not you were applying for the EIDL loan or if you were applying for the advance or the grant. This is where it created a lot of confusion during the application process, early application processes. A lot of people were relying on their financial institutions to fill this paperwork out. They were relying on, whoever was selling them on, hey, let us fill it out. We'll charge you $7,500, whatever they were charging for. They shouldn't have been charging you anything to fill it out. But some people were out there assisting the general public in filling out these applications. You could have gone directly to the SBA website and filed it yourself. But if you wanted somebody else to do it for you, that was a more popular avenue for most most people. So early in the application process, when people were filling out the paperwork, they didn't really understand the difference between the grant and the EIDL loan. The grant is actually something that caps out at $10,000 and is divided into $1,000 increments per employee that you have under your business. So let's talk about the sole proprietors first. Let's say that I am Tony Watson, real estate professional, no employees, just me working for my own business. I'm not incorporated. I just have a Schedule C sole proprietorship. If I applied for the EIDL grant, I would only get $1,000 because I'm the only employee that I'm applying for. Let's say that I did have a corporation. Let's say that I ran, a nice, successful little real estate business. I had my son as an employee. My wife was also a real estate professional. She was on W-2 through the company. Let's say I had 3 employees under my corporation. Well, when I went to apply for the $10,000 grant, I got $3,000 deposited in my account. And that's because I got $1,000 per employee. All right. So a lot of clients were confused. They were like, why did I only qualify for $1,000? Well, it's because you didn't apply for the EIDL loan. You applied for the grant or the advance of the loan, which could be $1,000 per employee. Now, the great thing about this $1,000, we'll talk about the loan side in a second. The great thing about the $1,000 is as of now, and I think that this is going to be how it is even at the end of the year, the $1,000, one, does not have to be paid back. That's always been the case. But also it is not going to be taxable to taxpayers, meaning that it was $1,000 that was just meant for the business owner and that's it. That's as of today. There's some whispering in the tax industry saying that no, the government's going to come back and say, well, because that was income to the business and it's not something that is a loan, it doesn't have to be paid back, it was free money, that it will be taxable. I don't think that's going to happen personally. I just don't think that's going to happen. We don't have final legislation on it from the tax code, from the IRS. But as of now, that is not taxable and it does not have to be paid back. So once you got that $1,000, great, it was yours. The loan, the EIDL loan, the other side of this application process, at the very beginning, the loan application was you applying as a business that had under 500 employees for a loan up to $2 million. That was the initial application. Well, everybody knows that the first round of funding of the EIDL and the PPP, it went very, very quickly. That means that they were issuing $2 million loans left and right. Fraudulent applications were being filed, misrepresentation of income and expense figures all over the place, ton of fraud. And I'm sure that we'll hear about this in the upcoming months, if not early next year during tax season. But the federal government knew they allocated, and they always do this, they kind of hedge their bet, meaning that they may allocate like 6 or 8% to fraud, and they expect the rest of it just to be legitimate applications. I think we're going to find that statistic is a little bit higher under this particular situation because every bank at the first round of funding, every bank was processing loan applications in a different way. They were pulling numbers off tax returns that weren't correct. They were telling clients to say and telling them, hey, give us a profit and loss statement that shows that you have $100,000 in profit or $200,000 in profit so you can qualify for more. Well, that's falsifying information to apply for a federal loan from SBA. Like you can't do that, right? Well, a lot of people were doing that. And that's why the first $480 or $500 billion went very, very quickly, right? So now under the second round of funding, which also ended, the second round of funding, they actually dropped the max loan amount from $2 million down to $150,000. Thank goodness, because then it extended the life of this fund. Well, that went very quickly as well, or it is going very quickly. And once again, they're still currently processing old applications. Under the HEROES Act, they're probably going to open this back up. There will be a whole other round of funding, so you can apply at that point. But this EIDL loan was not like the PPP loan with the 1% interest rate. When you actually qualified for, let's say, a $100,000 EIDL loan, this was a legit loan. They pulled your credit. They had to make sure that you had assets and debt to income and all of this information that basically proved that you could pay this money back. It was still a great deal though, because whatever money you qualified for, it was a loan at 3.75%. I mean, throw me into a bucket where I can get $2 million at 3.75% and I'm good to go, right? So people, and it's a 30-year term, by the way. It's not like this 2-year term like the PPP at 1%. It's a 30-year term, and you can consolidate those loans with other SBA loans down the line. That's a whole other conversation. But it's a 30-year term with 3.75%, but only for businesses that had under 500 employees. We saw the Lakers apply for one. A lot of people thought that was completely, just a bunch of, pardon my French, but crap. And I agree, but the Lakers returned it, number one. Number two, it probably wasn't anybody in the Lakers organization that applied for it. It was probably their accounting division, which that's what we do. We apply for these benefits, whatever benefits are available for us. They didn't need it. They sent it back. I am hoping that a lot of the business owners that didn't need the EIDL loan, I'm hoping that they're sending it back to SBA because more people need that money. The people who actually are hurting, they need that money. Now, here's the kicker. If you think that they weren't supposed to send back the money, and let's say they don't send back the money, at the tail end of all of this, when the dust actually does start to settle, the audit procedure on the banking side and the audit procedure on the federal government side will be built better than the auditing that they have right now for individual tax returns. Because like I said, there was so much fraud over the last 3 months with filing these applications that the federal government wants to nail every fraudulent application that was submitted. The penalty right now for a fraudulent application is up to $1 million. The penalty. Just the penalty. That's a lot of money in the tax industry. For a penalty, $1 million is a lot of money. But I understand why they're doing that, because people who actually needed these loans, they weren't getting it. Maybe they had a lending institution that was able to push through the application first before the other loan applications because they had larger assets with the bank. Who knows what the reason was, but that money went very quickly. We will have another round of funding through the HEROES Act. We don't actually know how much will be funded, but that is on the horizon. It'll be coming pretty quickly here. So the approval process was a little bit strict towards the end here, right before they shut down the application process. But the approval process, as soon as they accepted your application, basically the loan funded within 3 days. Now, this money from EIDL, you still have to use it for ordinary, necessary, and legitimate business expenses. You just can't go out and buy the boat that you've always wanted or the Porsche, right? But you can use it for business expenses, utilities, rent, health insurance, mortgage payments on a business loan. You can use it to pay for expenses that your business incurred that were ordinary, necessary, and legitimate right up until the time of the pandemic. You can utilize this money to pay for that. But once again, still a heck of a deal at 3.75% over a 30-year term. So as the dust starts to settle on the second round of funding, and we have a little bit more information about the HEROES Act, and once that passes or whatever the dust settle or wherever the dust settles on that, we'll have more updated figures with the third round of funding coming up in the next month or two. Let's talk about mortgage forbearance. I did want to spend a little bit of time on this just to really define what this is. It's not, in my opinion, this is just my opinion, by the way, we can agree or disagree on this. Mortgage forbearance, I don't really like to call it a relief plan. I don't like to call it a benefit under the CARES Act. I think that mortgage forbearance is something that if it is your last resort, it is there and in place to make sure that you don't, your bank accounts don't run dry. Okay. Because of the industry that I work in, I'd say that out of the 1,200 tax filings that I service, probably 700 to 800 of those returns are rental property owners, individuals that have other businesses, but they also have rental properties. So mortgage forbearance was one of the more popular questions, at least for me as a tax advisor with Robert Hall. Some of the other senior preparers, they have a lot of rental property owners as well. But clients were calling in saying, hey, do you know anything about this mortgage forbearance? Does it mean that I don't have to pay my mortgage? Does it mean that I can just go 180 days, not pay anything, and then be relieved of the 180 days of mortgage payments? First rule, if you can pay your mortgage, pay it. Okay. This is not something where it's a get out of jail free card where you delay it 180 days. And at the end of the 180 days, the bank says, okay, we're ready to start accepting your payments again. Make no mistake that if you don't make your mortgage payments, the bank will start to go through their formal process of probably in the end foreclosing on your property. You have to connect with your lender. The first person you need to contact if you are in trouble with making your mortgage payment, let's say a tenant has stopped paying you rent, whether it be a single family or a multi-unit, if multiple renters have stopped paying rent, if you feel like you are going to fall behind, you need to reach out to your lender and ask them what plans they have available for you. Because mortgage forbearance, in my opinion, once again, just my opinion, it should be the last option in your list of options that you're putting together. The lenders will actually be the ones to assist you in either doing maybe a slight loan modification, doing a full-blown refinance. I have a lot of clients, just over the past probably 2 weeks, we've sent out, just in my column alone, maybe 150 digital tax returns to lenders to get their loans refinanced. Now, whether or not that's because tenants aren't paying the rent or not, I don't know if that's the case with all of those emails, but I can only assume that this is the time that they want to go through the refinance because the interest rates are low, number one. Number two, through the refinance, they can actually skip a month of mortgage payment in most cases. So it tends to be a good option for the individuals who can qualify. Not everybody can qualify though, right? In a perfect world, everybody would qualify. Debt to income would be good. Cash reserves would be good. They'd have enough assets to leverage, and the refi would last 15, 20 days or whatever the time framing is. But that's not the case. Right now, it's a very, very serious situation that we're all in. So some banks are actually allowing them to take the 180 days of mortgage forbearance, wrap it onto the tail end of the year, so meaning January, February, March of next year, and they can spread that out over a 3-month period. I heard that one smaller lender, it was a credit union, I believe it was, small loan amount, they were actually allowing it to spread out over another 180 days and actually making payments that way without any additional penalties or interest. Sure, your mortgage interest accrues during that 180-day period, but you're not going to be penalized for not making your mortgage payment. Now, a lot of clients also said, well, what about the banks that don't allow that benefit? Do I have to pay it as a lump sum at the end of the 180 days? And that is a question that you have to ask your lender, because I don't know. I'm a tax advisor. I know the benefits and the kind of the pitfalls of mortgage forbearance. But at the end of the day, the lender is going to be the one to determine whether or not you get any relief for this. Obviously, they can't foreclose on your home right now, but you want to make sure you're in contact with them. Just like if the IRS sends you a letter, you don't want to put it on your countertop and wait 2 years to respond to it. You want to turn around and respond to that as quickly as possible to avoid any potential hassle or headaches down the road. Now, let's say that at the end of that 180-day period, you still can't afford to pay the mortgage. The bank will give you another 180-day extension. So 360 days, you can go without paying a mortgage payment, without paying interest on that mortgage. And then at the tail end, once again, you have to talk with your lender about what your options are. Does this impact your ability to qualify for financing down the road? It absolutely could. I don't know everybody's particular situation, and the lender will definitely assist you with this, and they'll have more defined answers for you. But a majority of it, we're seeing, yes, this will impact your ability to qualify for loans down the road. They're absolutely going to want to see if they have any assets they can leverage against. They're going to push you to do the refinance with the closing costs and everything. They're going to push you in that direction. But if it doesn't work, unfortunately, this would be your last resort. But once again, talk with your lender. Like the bigger banks, I know that Wells Fargo has been really good with a couple of my clients. US Bank has been fantastic with a couple of my clients. I don't have too many stories about B of A just yet. I'm sure that I will in the upcoming months. Smaller banks have been a little bit more flexible with the loans. So maybe even refinancing the loan with another institution, maybe will give you a little bit of flexibility there. So, but once again, I put up this slide to tell you that we don't know what each of your lenders has available for you as a relief plan of some sort. I don't think that forbearance of your mortgage payment, delaying it, is a benefit, but it definitely gives you some time to rebuild a little bit of cash wealth or a little bit of wealth for yourself, so that at the tail end of all of this, when our businesses are back up and running and your renters are paying the rent again, that you can afford to make these mortgage payments. So just keep that in mind. Accelerated depreciation. I want to spend a little bit of time on this. Accelerated depreciation is very unique for rental property owners. And I'm assuming that either most of us in today's webinar either have owned property in the past, do currently own property, are looking to buy their first couple properties, or who are in the midst of actually acquiring, exchanging, or selling a property currently right now. Those of you who are veteran real estate investors know what depreciation is, but for those of you looking just to jump right into real estate right now, depreciation by definition, simple definition, is the lifespan of an asset. So when you buy your first residential property, whether it be a single family residence or a 20-unit building, the residential depreciation lifespan for that building is 27.5 years as defined by the Internal Revenue Code. 27.5 years is a long period of time. You figure that, okay, well, if I buy a home for $275,000 divided by 27.5 years, I get a small write-off for that depreciation over the next 27.5 years. Well, under the CARES Act, they stated that, well, we're not going to change the depreciation lifespan of the building, but any qualified improvement property that you are depreciating, some of it can be accelerated without having to do a cost segregation analysis, some of these improvements can be accelerated and taken fully in 1 year. However, major structural improvements, like let's say I bought a rental property, I gutted the kitchen right before the pandemic set in, and I dumped $100K into this new kitchen. The workers weren't showing up. There was delay. So I'm not collecting rent. I got this kitchen that's being put in. Well, the federal government knows that because of all of the outside or outlying factors that could be working against you financially, that they wanted to make sure that the depreciation write-off gave you a larger benefit coming out of this CARES Act and coming out of this pandemic. So the federal government took the 27.5-year lifespan for certain qualified improvement property. They dropped it down to 15 years, meaning that whatever deduction you were getting for that $100,000 improvement, you are actually now getting double the write-off in this year, because they've taken that lifespan and dropped it down to about half, roughly. So 15 years is what you can accelerate that to. Now, if you've already filed 2019, if you've already filed 2018, guess what? You can go back and amend those returns and change it to 15-year depreciable lifespans. Now, 27 and a half years, if you want to keep it that way, sure, you don't have to do this. This is just an option. Because also for the veteran investors in the room, we know what happens with depreciation if we ever decide to sell the property. Not do a 1031 exchange, but if we just outright sell the property. All of this depreciation that we've now elected to accelerate in the year of sale, if we do not exchange the property, we have to recapture all of that depreciation, add it back onto return, and pay ordinary income tax at roughly 25% tax on all of that depreciation. So it's a great benefit while you're owning the property, but if you ever sell the property, not in an exchange, just outright sell it, then you got to pay the piper. And so there is a financial decision you need to make with your tax advisor to figure out, one, if this makes financial sense to go back and correct these things. Two, what is the 5, 10, 15-year plan for these properties? Are we selling the properties? Are we going to exchange the properties? What's the option here? And so it's more than just looking at the current year. It's actually looking at the 5, 10, 15-year projections, figuring out what the best move is for you in your particular situation. So just be aware of that. Now, obviously, there's a certain deadlines and September 27th of 2017, placed in service after December 31st of 2017. So there are certain things that you need to be aware of when looking at these changes. If you're a self-prepared taxpayer, for instance, just don't go back and start amending tax returns. You need, unless you know the tax code, unless you know the CARES Act and you've studied it, make sure that you're sitting down with a tax advisor and making sure that it's the right option for you. 1031 exchanges are obviously the best exit strategy in most cases for real estate rental properties, because in the exchange, there's no recaptured depreciation, there's no capital gain tax on the federal or the state side. And the only thing that's really changed with the exchange since the new tax bill in 2018 was the fact that you can only exchange real property now. You can't exchange a tractor for a dump truck. Because that's not real property. You can only exchange property now, building and land, both commercial and residential. So this particular benefit applies to real estate owners as well as restaurant and retail businesses. And this is a great option for you to accelerate some of these write-offs, to increase cash flow, decrease liability. But once again, some of you may be limited on some loss deductions that you're taking because you might not meet the real estate professional requirement. You might have another job where you make too much to allow you to qualify for the loss deduction. There are a number of situations that make your tax return unique. So I don't want everybody to jump on their TurboTax program and start amending tax returns. You need to have a discussion with someone like myself about whether or not this makes sense financially. Okay. Let's talk about the stimulus check. I do want to get through this so I can answer all these questions that you guys have. The stimulus checks, remember, they are still coming. So don't worry if you haven't gotten it yet. It's just because things have been delayed. Clients have called me and asked me, well, how did they determine who got the checks first? I have no idea. You could probably guess that the IRS maybe sent them to lower income earners that earned less income in 18 and 19. Maybe they thought that those individuals needed the money faster. We thought maybe by alphabetical order, that wasn't the case. And some clients still haven't gotten their checks. Direct deposit is no longer an option, by the way. If you are still waiting for your check, what I would suggest is one of two things. Either one, you wait until next year to apply for it on your return, or go directly to the IRS website, type in track my stimulus check, input your information. But when you're inputting your information, type everything in all caps. Don't type it in lowercase. Don't ask me why. I have no idea why this works on the IRS website, but the IRS says that if you type it in all caps, it will probably work. If you type it in lower cap letters, it's probably not going to process, and it's going to give you like this error message. So sometimes if you type it in all caps, it still gives you the error message. And at that point, you may need to wait until next year to apply for the refund check. It is not taxable. This is the general misconception about the stimulus check, is that, hey, the government's going to send us all this money and it's going to be taxable. No, that is false. This money is not taxable. It doesn't need to be paid back. If you weren't supposed to qualify for it, let's say that in 2018 and 19, you made well above these thresholds, and just by chance you got this check from the government, which some clients have, that will be taxable, okay? Because you weren't supposed to qualify for it. So understand that on the back end, yes, it will be taxable for people who weren't supposed to get the check. And for the deceased taxpayers that are getting the checks, I'm sure you've seen this on the news, where, you know, a loved one is deceased, they got a stimulus check, you cashed it in the trust account. That check was not supposed to be received. And so at the tail end of this, once again, we don't have current legislation on this, but it will either become taxable or you will have to pay it back on your individual tax return or on the trust return. So just be aware of that. IRS hasn't come out with final detail on all of this yet. So just be aware that we're going to have a number of webinars coming up over the next couple months with these updates. Okay. Things to look out for scam wise: fake websites, phishing and vishing. You can look those terms up online. Spoofed government and health organization communications, miracle cures. Like, hey, my neighbor says that he has the cure for COVID-19 that he made in his garage. Don't give him any money, okay? This is something that's very silly to think about, but this is happening in the United States right now. Fake job postings, okay? Things that insist that you act now. It includes personal requests for financial and medical information. The IRS will never call you. They'll never call you on the phone. If you get a call saying, hey, this is Social Security, hey, this is IRS, you need to pick up your credit card right now and pay us all this money, we're sending the sheriff to arrest you. Hang up. It's a scam. And this is happening a lot. Identity theft has become the #1 crime in America. Gosh, over the past 10, 15 years, it is now the #1 crime globally. Okay. So just be aware of a lot of these scam artists out there trying to take what you have, trying to take advantage of you during these uncertain times. So just be aware of all of that. Okay. Obviously, the CARES Act in itself is probably like a 10 to 12 hour seminar. I did want to mention that Robert Hall and Associates, we offer free consultations. This is a free 30-minute in-person, once the pandemic kind of subsides, in person or now over the phone via FaceTime, Skype, Zoom, however you want to connect with us. You can text RHA to 38470, and then we'll talk about a couple other things really quick, and we'll open it up for questions. For real estate investors, something very unique is built into the current tax bill that you need to make sure you're taking advantage of. Aside from the CARES Act benefits that were built in, the PPP, the EIDL, mortgage forbearance, however you want to look at that, one thing that is set in stone for real estate investors and self-employed individuals is something called the qualified business income deduction. Now, this is an added benefit, not for me as a W-2 wage earner, but for you as a self-employed real estate investor or real estate professional or any other self-employed business that generates profitable revenue each year. In order to get this benefit, you actually have to show profit. If you're showing a loss, the benefit is that your loss doesn't pay tax, right? So in order to get this benefit, your business has to be profitable. Your rental property has to be cash flowing. Now, what the heck is qualified business income? Qualified business income is pretty simple. It's rental income and self-employed income. Now, if you have one of these two types of income on your tax return, I missed a slide here. If you have one of these two types of income, you potentially could be receiving 20% of your company or property's income in 2018 and 2019 tax-free. Let me break that down for you into a little bit easier numbers to understand. Let's say that you have 5 rental properties or a 5-unit building and you've paid down the mortgage, or let's say you've inherited this property and it has no debt and it's cash flowing every year, and every conversation you have with your tax advisor, with your financial planner is always like, well, what should I do to pay less tax? Well, eventually, if you've tried everything, the 1031 exchanges, the cost segregation, the improvements to the property, accelerated depreciation, even then, let's say that you're still cash flowing. Built into the 2018 tax bill, if your income, if you're married filing joint and your taxable income is under $321,000, if you're single, it's under $160,000 roughly taxable income, the first 20% of your real estate cash flow or your self-employed profit is tax-free. That means that if you are a married filing joint couple and you have 2 sources of revenue, rental income and self-employed income, let's say you add those profits up, let's call it $100,000 in profit, you're under the 321 threshold. That means that $20,000 of your $100,000 of income is tax-free. It pays absolutely no federal income tax. So the game here is to qualify for this benefit. That's 20% of your qualified business income you pay no federal income tax on. Now, who has not conformed to this part of the tax bill? California. So California does not allow for the 20% benefit. This is only a federal benefit. And if you can imagine, if you have a really great year and both you and your spouse are making, let's say, $300,000 in qualified business income, that is $60,000 of your income that pays nothing in federal income tax. So once again, this is a huge benefit if you qualify for it. Your income threshold has to be below a certain amount. Even if you're slightly above that threshold, it's not that you lose the benefit, you just start to phase out from being allowed the full benefit. At about $420 some odd thousand married filing joint, at about $210 single, you've fully phased out from being allowed that benefit. So right before the tail end of the year, it's very important for you all to sit down and do some year-end planning to see if you're right on the cusp of this bracket. Let's say you're sitting right above it and you're only getting 16% of the benefit. Well, let's go ahead and make that improvement to the rental property, or let's go ahead and max out a deferred comp plan, IRA, self-directed 401, solo 401k, self-directed IRA, to drop your taxable income below this income threshold. And now you get 20% of your income tax-free. After you calculate all of those moves, all of those implemented strategies into play, the ROI, the return on investment for that particular adjustment, could be 35, 40, 50 cents on the dollar. This is something that a good tax advisor will map out for you before the end of your calendar year, and it's only meant to benefit rental property owners and self-employed business owners. You can even be a partnership, an LLC, or an S corporation and still qualify for this benefit, but what you cannot be set up as is a C corporation. C corporations do not qualify for the QBI deduction, so just be aware that one type of entity does not. All of the rest of the entities do, because they are all pass-through income, which qualifies for either rental income or the self-employed income, both in the real estate industry and other industries. Once again, just wanted to remind you, we do offer free 30-minute consultations. I'll throw this back up at the end. Mortgage interest and property taxes, my last two topics here. Mortgage interest, obviously it's still a great tax write-off. A lot of clients are saying, well, should I pay off my home so that I don't have the mortgage interest because it's not a tax deduction anymore? Whoa, whoa, whoa. I don't know where they heard that mortgage interest wasn't a tax write-off anymore. It still very much is a deduction, but it may be limited depending on when you bought your home and how much debt you have on this home. Rental properties, guess what? There's no limit. See, the great thing about having a business like a rental property is that, number one, it'll appreciate in value over time. Somebody else is paying for the debt, right? And the more money you put into it, the more equity you have in the business, in the property. That's essentially how it's supposed to work. You're supposed to increase the value of the property with improvements, and that gives you more value to your investment. Well, mortgage is a very common way for somebody to leverage their own credit, their own money, to qualify for something that's worth way more than what they're putting down, right? So the business side of it, the federal government didn't adjust mortgage interest for rental properties because you own a business. It's a rental property. It earns revenue. It has expenses. So therefore, it is a business deduction. There is no limit to mortgage interest on a rental property. But on your primary residence and on a second home, a home that is not rented out, a home that is used for vacation purposes as a second home, truly a second home, you have to be very careful. Under the old tax bill before December 31st of 2017 and before, you were allowed on your primary and your second home to write off interest on the first $1 million of acquisition debt. If you bought that home, your primary or a second home, after December 15th of 2017, you had to play by the new rules, which under the new tax bill, you're only allowed the interest deduction on the first $750,000 of acquisition debt. Now, this is $750 for your primary, $750 for your second. But if you bought the home before that date, you're grandfathered into the old rules. So you're allowed the interest on up to a $1 million acquisition debt. That's for primary residencies, the homes that we live in, and the second homes, not for rental properties. I want to stress that enough to where you all understand that the benefit for business is still there under the real estate side, okay? We don't buy real estate for the tax write-off anyway. We buy real estate because it is the most consistent appreciating asset we park our money in. Whether the economy is good or bad, people will always need a place to live. You know, and even more so during a down economy when people unfortunately are losing the homes that they're living because they can't afford it, they're gonna need a place to rent. And so there you are with your rental property ready to support the people who are really, truly, tragically being impacted by the economic downturn. So mortgage interest still a very, very great write-off for a number of reasons. It is mostly dollar for dollar on investment properties, unless you have different types of mortgages on the property, like equity lines of credit, or let's say you have business interest. It's deducted different ways. It's not included as mortgage interest. It's put on a different part of the return, but nonetheless, it's still a great business write-off for the Schedule E. On the primary residence, the second home side, you got to be careful. You have to make sure that your accountant is limiting this. It's not the Wild West like it used to be 10, 15 years ago where you just plugged in the interest deduction and the government allowed you to have it. They are going to track that information now. Your 1098 mortgage interest statement, it not only has the interest deduction amount that you paid, but it has the loan origination date, it has the loan amount, it has the address that the loan is attached to. It says whether or not you are actually required to pay back this debt. I mean, the 1098 tells the whole story. So just be aware that there are slight changes between 17 and 18 that you need to be aware of for this particular deduction. That has nothing to do with this $10,000 cap that people have been talking about. The $10,000 cap is the state and local tax deduction. This includes your property taxes, your state income tax deduction, your DMV fees, your sales tax, everything that you pay in state and local tax. Now it is capped at $10,000. A lot of individuals, I'm not going to go too much into detail about this tonight, but a lot of individuals, even some of my clients in past, didn't realize that there was already a limit in place. This is not something that's new. Under the old tax bill, if you want to look it up online, there's something called alternative minimum tax, AMT, that actually already was disallowing or limiting the amount of SALT deduction you were able to take on your personal tax return. Now remember, the SALT cap is only a cap on your primary residence property taxes and your second home property taxes. What's the cap on your property tax deduction if it's rented out? Nothing. There is no cap. It is a business, just like the mortgage interest deduction. Once you convert a property into a business, there is no cap to what you can deduct in property taxes on that property. So just understand that all of these limits pertain to the primary and the second home, and they might not have impacted you as much as you thought or assumed it would. If it did, you need to understand why. Sometimes there are adjustments that you can make to maneuver around some of these limits. For instance, if you have an in-home office, you can allocate a portion of the property taxes to your in-home office deduction and then allocate the rest to your Schedule A, which is limited to the $10,000. So talk with your tax advisor about whether or not you were impacted or how you were impacted by the 2018 tax reform, and take notice of what those changes were, because maybe there are some strategies that you can implement to avoid some of these serious limits that people saw under the 2018 tax reform. So just keep that in mind. What else should you be doing? You should be educating yourself. That's why we offer this free consultation at Robert Hall & Associates. We want to make sure that people have correct, up-to-date information, that they have assistance with reviewing the applications that they're filing with SBA. We want to make sure that you have correct tax filings for when you're ready to go and refinance or buy a property. We want to connect you with like-minded individuals, just like in FIBI. We want to be connected with like-minded business owners, not only here in Southern California, but across the US. So this is something that we've been offering for the past, 9, 10 years now at Robert Hall. It is free, 30 minutes for you, for your neighbor, your coworker, your friend, family. It doesn't matter who it's for. All they got to do is text RHA to 38470, and that automatically submits their name for the free 30-minute consultation. We reach out, get you all set up, and boom, we're off to the races. If you don't need to talk about any of the stuff we talked about, let us review last year's tax return. See if we would change anything. That's probably what most people would benefit from anyway. So that's it for me.
Thank you, Tony. We so appreciate it. Thank you, thank you, thank you. This is great. I actually do have a couple questions.
Yes.
So if you still have a little breath left after all of that speed talking, you did great. You covered a lot of information in a very short amount of time.
There's a lot of info.
Congratulations. You did very well. So I have a question here. So let me give you the first one. I was looking at the PPP, but I don't have a Schedule C income. I also don't have my real estate business set up as an entity. So from what I can tell, I am not eligible. Is that correct? Can you clarify? Do you want me to read it again, Tony?
Yeah, so the PPP, I think I'm looking at it right. Is this from
Lynn?
It's from Lynn? Okay.
It's from Lynn, yeah.
So if you don't have Schedule C income, if you don't have any sort of self-employed income, generated on your tax return, whether it be a 1099 from real estate, a 1099 from an Amazon business, a 1099. If you have no self-employed income, the PPP loan would not be the loan for you. The PPP loan is actually meant to supplement loss of self-employed revenue. And if you have no self-employed revenue, unfortunately, the PPP plan would not work for you. There's two main forms that the banker will look for on your tax return if you have a copy of it. And if you don't have a tax return, they'll ask for something called a profit and loss statement. And the profit and loss statement kind of takes the place of a Schedule C. And so if you don't have either of those two forms to show what your average monthly net revenue was for your business or is for your business, then the PPP loan wouldn't fund. So unfortunately, no, in that situation, you would not.
I could get a P&L put together, and
You could?
I think I might have 1099 because a lot of it was interest income. And then I had some K1 income, but I don't have specifically the Schedule C.
Gotcha. I actually, with a new client of mine who did not have a Schedule C, he had a profit and loss statement. He sent it over to me. I created a Schedule C, not a tax return, but just a Schedule C. And the lender that he was using, I think it was Wells Fargo, actually accepted that Schedule C for the PPP loan. Remember that there are a lot of people who are fraudulently filing these documents. So if it was just as easy as you coming up with a profit and loss statement and filing it and getting the PPP loan, then obviously the banks wouldn't be doing their due diligence. So remember that on the back end of all of this, there will be an application. In fact, this application came out last week where you actually have to fill out and apply for the relief of the loan. And if you don't have the necessary documents, which include a Schedule C, profit and loss statement, and bank records of this business income, then it would not be a forgivable amount, meaning that it converts to a loan at 1%, which isn't too bad. But then on the back end, if you didn't qualify for the relief plan, there's a second round of auditing to make sure that the actual loan was legitimate. So we'd be more than happy to take a look at what you have to figure out if there is some sort of qualification that you can.
Because I definitely had the income, which I don't now. It's just the way that it was structured.
Well, if you had income at one point and now you don't, that's a perfect example of why the PPP plan is available. So if you had income throughout 2019 and at the beginning of 2020 was just a little bit slower, let's say you had no revenue in January, it doesn't matter. As long as you had self-employed income at some point in 2019, that still gives us the ability to show a self-employed revenue from that tax. It does not need to be right up until the time of the pandemic.
Right.
Cool. All right. The other question we have is, I have a full-time W-2 job, and I also work as a self-employed realtor. Can I apply for PPP?
For the payroll protection program, you can, not for the unemployment, right? Because you have a full-time W-2. So through your business, it's separately, you can apply. You're not going to apply under your company's name that you work for, obviously, because that's not the business. The PPP plan was meant to supplement loss of business revenue. And if all of a sudden your business, I'll give you a perfect example. My father and my mother are both professors. My father owns restaurants, though. They're his businesses. He doesn't manage them anymore. He'd rather just teach and collect a check from the businesses. But those restaurants have been shut down. Now, thank goodness my father has been a good real estate and financial investor. So he's doing just fine at the moment, but there's no money coming in, right? That's a perfect example of, he didn't want to lay people off and he was paying out of his pocket right up until the PPP plan was allowed. And he didn't qualify it for a payroll for him. He qualified for the PPP to pay his employees. So even though he's currently teaching and receiving a W-2 and even a little bit of retirement income that he's collecting because he's over a certain age, he was able to apply for the PPP and keep all of his restaurant workers on payroll. And that was the main benefit of the PPP, is to make sure that those individuals were not laid off. Now, here's the underlying factor that's going on right now. Some individuals, I just dealt with this situation today, some individuals are actually making more through unemployment than they are being brought back onto payroll. I don't know if anybody's heard of that particular situation, but PUA for some individuals, it's paying them $600 a week. Plus they're collecting unemployment from an old W-2. Like one of my clients is collecting like $800 a month or $800 a week in unemployment. And he's like, why would I ever go back to work right now if I'm able? And I don't think that's the right approach, but we're running into this situation where sometimes these other supplemental programs actually will kick you more back than the PPP loan when it has to be paid out for payroll. But once again, yes, to answer your question, I know that was kind of a long-winded route, but yes, if you have a W-2, if you have a business, you could still apply for the PPP under the business.
Okay. We did have a request for, what was that text number again? I'm going to put it here in the chat box.
Yeah, it's RHA So Robert Hall and Associates, RHA to 3847. Is it three? Sorry, hang on one second. 38470. I knew I was missing a number.
38470.
Correct.
Okay.
Yep, my name's Tony Watson too. So you don't have to include my name on it. I'm the only public speaker at RHA, so they know exactly where the leads came from. So when you text that in, they'll know that you spoke with me, and then they'll look at our calendars. They'll try to match us up whatever date you can meet. And obviously not in person at the moment, but if you want to delay the 30-minute consult and wait for us to open back up, I got chairs waiting for butts and seats in my office. So we can absolutely do this at any time.
All right, Tony, we have one more question. You can see it in the chat box. I'm going to let you also find it. It's from Andy. Can you fund a solo K for your side gig if there's a 401 plan available at your full-time job?
So the Roth IRA, I know without a doubt, you can't have a Roth IRA funded at, let me put it between us and the four walls, essentially. The Roth IRA, if you accidentally put money into your Roth IRA and you fund a retirement account through your employer, technically, you're supposed to go and take that money out of the Roth because you've already maxed out the benefit with your employer. The solo 401k and the employer 401k, if you're already doing the max, let's say $19,000 or up to $26,000 under your employer's retirement plan, you cannot also be funding a solo 401k. Now, if you have a solo 401k and you have a business, the company can do a profit sharing plan contribution into the 401k, but not the employee contribution. Because remember, the max employee contribution on the employee side, not the business side, but the employee side is either the $19,000 or the $26,000 max amounts. But once again, if you own a side business and the business has enough profit to issue you a salary, the company can contribute 25% of your W-2 compensation into that solo 401k as a profit sharing plan contribution. But you as the employee, you can only put, if you're maxing it out over here, you can't do another max over here.
What if you're not maxing it out?
So
Can you put into both if you don't max out?
Yeah, see, the unfortunate part about that is that, yes, technically you can in theory, but on the tax return, your W-2 with your employer has a box that's checked that says that you defer money into a retirement account. When we check that box in the tax return software program, in any software program, it disallows the deduction for the other retirement contribution. That's why I'm saying that your company can make the contribution because that's on a company return. But the employee side, when we're putting in those numbers, if we check the retirement box on your W-2, it suppresses the ability to deduct the solo 401k contribution. So in theory, yes, you can put money into both. You just can't deduct it.
Okay.
I mean, I'm not telling you that you should do that. But if you do that and the money's in there, just understand that it's not going to be a tax write-off for you.